if you want a headline, David, my headline is Lobo Tigre doubles down on hard landing. I really do think that's coming. I think that the the degree to which these things that I'm talking about, labor hoarding, post-pandemic distortions in the market, have prevented or held off the recession from, or the piper from being paid. To the degree that you hold him off, that you increase your interest payment when he does show up for payment. So I think the hard landing, left to its own devices, would be much harder than it would have been had it been left to sort itself out.
Lobo Tiggre of the Independent Speculator joins us once again to give us his updated outlook on the macroeconomic landscape. What's next for stocks, the economy, and commodities? The Bank of Japan raised rates for the first time in 17 years. I was talking to you offline. I'm going to quote an economist I know, Peter Berezin. He posted this on his LinkedIn. In the history of finance, no better indicator has been this perfect in predicting recessions than the Bank of Japan raising interest rates. This chart, I think it's a tongue-in-cheek chart, but every single time the Bank of Japan raises rates in the past, barring the COVID pandemic, there's been a recession like 6 to 8 months later, max. So here we are.
It's kind of funny that that comes up, every time except COVID. So I think it's actually kind of important, David, because we are in uncharted waters. And you can say, oh, except COVID, but COVID was the last incident. And the things that have been done have been, so many charts have been broken with lines going through what was the top before or through the floor before. So it is reasonable to question whether patterns that have held true before still hold true. I'll give you an example, a contra Lobo indicator. The leading economic index has never gone this long negative for so many months without the recession. We're overdue. So, according to, and those are leading economic indicators, right? They're supposed to lead where we're going. They turn negative, I don't know, what is it, 20 months ago now or more? And they have never gone that long without the ensuing recession. And so there's people who are saying, well, if it hasn't happened by now, it's not going to. And to point at that, they would seem to be right. But if we are in uncharted waters, you can't go by previous charts that seem to work. Back on the plus side, clearly if the Bank of Japan is forced off zero, which they really didn't want to do until they absolutely had to, it's indicative. It means something. So another chart, I don't have it handy, but Jeff Gundlach, I think most of our audience is familiar with him. He frequently does monthly updates with lots and lots of charts. But his most compelling recession chart is always long-term unemployment versus current unemployment rates. And when you get a death cross in that chart, and that is an uninterrupted 100% success rate at predicting recessions. And we're headed right there now. I think the long-term line hasn't quite crossed yet, the short-term one. But we're on the verge of that death cross. And if you use a medium term or shorter term lines, they have crossed already. So this softening that even the mainstream cheerleaders of the administration or the economy in general are admitting to some softening in the labor market, that's showing in the charts. And smart, experienced guys like Gundlach are saying that is the most ironclad predictor of recession, including 2020.
Before we talk about your indicators of a recession and what you may look at to make this assessment, back up a minute. Why do we as investors care if there's a recession? Let's really think about that question. What moves during a recession? Which assets do well? Well, we know which assets do poorly, but I think what we want to know is which assets do well during a recession, right? Ultimately, why are we talking about this?
Right. No, that's a good question. And actually, I will answer, but let me go slightly sideways and point out that there's an important distinction between recession on the one hand and a market crash on the other. And a lot of people seem to think that the two are the same, or assume that if there's going to be a recession, there's going to be a market crash. And that's not necessarily true, because if it was true, then recession, obviously markets crash, then that's a reason to go short risk and go into other safe haven assets, which includes gold, mainstream, as well as bonds. And I would much rather go with the gold with the bonds in this environment. But that's a mistake. And especially now that the Fed has trained the markets, it's almost a Pavlovian thing. And that's why we've been scratching our heads about bad news being good news for Wall Street for years because of the expected Fed put. And in this case, I think that's not an unreasonable expectation. I think if we had the Fed's second mandate called in, that they would pivot, fast as you could. And not just monetary policy. I think we'd see a fiscal response. And markets are forward looking. So markets could look at a recession and say, yay, the floodgates are going to open. The easy money is going to flood the markets and the money helicopters are going to fly. So, hey, go long, go risk because the money is coming. So it's important not to conflate the two, market crash with recession. But if the reality on the ground is recession, those have been historically always very bullish for monetary metals. That's gold and silver, not platinum or palladium or rhodium. Sorry, those are industrial metals. So it's primarily gold, secondarily silver. It's also, at the outset at least, depending on monetary policy, the fear can be good for bonds, but we have to see how that works in uncharted waters. It's bad for industrial minerals and commodities. And it should be bad for the stock market as a whole, but as we've said, in the bad news is good news world on Wall Street, it may not be, but it probably will be bad for commodities. So commodities markets don't seem to get the same treatment from Wall Street that the equities markets do. And bad news is just bad news for commodities. If there's a downturn in the economy, that's bad for iron, it's bad for oil.
The Fed can't save commodities, is what you're saying.
Yes. It's actually arguable whether the Fed can save anything. Here we are on Fed Day. And, what they do, does it really matter? Their toolbox is actually quite limited. And if it's fiscal largesse, that's really still that pig working its way through the python that's making inflation sticky, do their interest rate decisions really matter that much? Are they trying to hammer a screw or turn a nail?
Yeah, arguably what's more important is what they do with their balance sheet. You're right. Okay, so we've answered what does well in a recession. Recession indicators that you look for then. Let's talk about that.
Well, we've seen quite a few already. We've seen an earnings recession. Even Wall Street is not entirely divorced from Main Street, so that's interesting to me. We've certainly seen a commodities recession. If Dr. Copper is called that for good reason, okay, we've seen higher copper prices with some interesting optimism coming out of China. But still, the commodities complex has been signaling an economic downturn. We've got conventional indicators from Germany to the UK to other, large economies flashing red around the world. I think it's not much of a stretch to say that there actually is a global recession going on. We're not just looking at indicators, we're looking at a reality right now on the ground. And then the question is the US the exception? Does American exceptionalism apply here? And I would argue that again, we're in uncharted waters, but given how we got here, if we have the post-COVID distortions in the labor market, the labor hoarding, the companies not wanting to fire people they really don't need because of how hard it was to find people during and after the COVID situation. So then that pillar that this American exceptionalism rests on, of the strong consumer laborer, right? If that is not as strong as it looks, or if it's artificially been propped up post-pandemic and then that breaks down, then things change in a big way. So if you want a headline, David, my headline is Lobo Tiggre doubles down on hard landing. I really do think that's coming. I think that the degree to which these things that I'm talking about, labor hoarding, post-pandemic distortions in the market, have prevented or held off the recession from, the piper from being paid. The degree that you hold him off, that you increase your interest payment when he does show up for payment. So I think the hard landing, left to its own devices, would be much harder than it would have been had it been left to sort itself out. And then the question, of course, becomes, what do the powers that be do? So I'm doubling down on hard landing, but I do think the money helicopters will fly. And the timing of this is really the critical point. Do the powers that be open the easy money floodgates the moment it looks like that recession is coming, or do they wait until the NBER declares in hindsight, oh yeah, we're in a recession? I have a feeling they may not wait. I mean, there's as we speak on Fed Day, it's really quite striking to hear the debate about whether the Fed should be loosening or how quickly it should be loosening when supposedly the economy is doing so great, right? The Biden team, not to get political here, but the Biden team keeps pulling their hair out over why Joe doesn't get credit for wonderful Bidenomics, how great that's doing for the economy. But the reality on the ground is not that great. These numbers that they look at don't account for the reality that people are experiencing on the ground. So, I'm saying things are worse than they look, and these contrived averages and GDP numbers and CPI and hedonically adjusted, super core CPI, all these numbers they keep coming up with. But the reality is different, and I think the reality will be out. And I suspect, though, that Powell and company that they know this. They can't admit it, but they know it. And so sorry, I'll stop talking, David. My point is, though, that this recession, this hard landing I'm looking for, could trigger the next boom because of the Pavlovian Fed put response and also fiscal policy.
Sure.
So equities could do well, but still industrial commodities are likely to take it on the chin for some
By the way,
time.
we talked about uranium before, but let's just revisit that, okay? Is the price of uranium indicative of either the market perceiving economic strength or actual economic strength, or are they not related at all? I ask this because, as you know, and we've talked about this, the price of uranium shot up. I want to ask you if that's an indicator for anything on the economy.
I wouldn't dismiss it entirely. I've said that uranium is recession resistant, not because nothing is entirely recession proof. But it is the best source of 24/7, 365 baseload power. And that's not the sort of thing that you want to mess with. You may decide in a recession not to go visit grandma as often and drive less and use less gas, but you still want the lights to come on. And broadly speaking, as a society, you still want the energy for your airports and hospitals and things. And that's where nuclear really excels. So I won't say it doesn't mean anything, David, but I will say that it is a separate consideration. It's much more important when you're looking at uranium to look at the supply and demand balance in the market, look at what secondary supply is doing to that. I don't think that uranium going to over $100 meant that the economy was going to go zooming off to the moon. And I don't think that uranium correcting now is that's not a recession indicator that I'm looking at. I just think the market got ahead of itself and some correction was to be expected. And boy, did I get a lot of heat for saying that in Vancouver when we met last. But I'm not sure where you want to go with this. But no, I don't see it as an indicator.
I just want to know if uranium going up means the economy is booming.
No.
Yeah, simple as that.
You could absolutely have the economy in a significant recession and uranium still go up because the supply isn't there for all the reactors that are being built around the world, which is scores of them, David.
Let's play a quick game of true or false, okay?
Okay.
Pretty simple. Just true or false, give your justification. True or false, inflation will not come down below 3% this year.
Well,
I'm talking about headline CPI, yes.
Yeah, okay. Yeah. It doesn't matter. Right. Sorry, true and false. I don't know. It could, but it wouldn't really matter. I think it's going to be sticky. So let me say, so let me go with false then. I'm closer to false than true. All right. You got to put that where, so the justification would be it's sticky already. I said it was going to be sticky. I was right about that. And if you look at the charts, they're pretty much flat over the last 9 months. And that means we're getting the end of base effects, which will no longer help. So the stickiness is about to get stickier and more difficult. I don't have a crystal ball, so I don't know where it's going to go, but much closer to false than true. Next.
True or false, the Fed will only cut if the economy shows obvious signs of a recession.
False.
Okay. They'll cut for other reasons, yeah?
Yeah, because if I'm wrong and inflation does get unstuck and goes down further, then doing nothing would be increasingly restrictive by their definitions. And they've already talked about this, that yes, it does make sense to them if inflation keeps going down to maintain the same level of restrictive, which they say, not me, this is the Fed, they say they're at sufficiently restrictive now. So if inflation keeps going down, you'd have to cut rates to maintain that same distance, or else you would be you would increase the restrictiveness of policy if you didn't cut. So there is a path where that would happen, but that's not what I'm expecting. I'm expecting them to cut because they have an oh beep moment when they realize they've broken something else or that hard landing is coming.
True or false, the unemployment rate will not tick up later this year?
False. It's already ticking up.
Let me rephrase that. Considerably, more than 1% higher than what it is now.
More than one. If you just said considerably, I would have said true. If you say more than 1%, I don't know. It could depend on what they do and how they define it, discourage workers. But I think there's a good chance that we will see it go 1% higher. If I'm right about hard landing, even if they throw the money at it, David, it takes a while for policy to impact things. And if companies that have not fired people that they didn't need anymore suddenly start doing that or going bankrupt and then, firing everybody, right? The easy money isn't going to instantly create those new jobs. So I think there's a pretty good chance that the answer will be yes to that.
This is an article from the Wall Street Journal. This has nothing to do with a soft or hard landing, but it's just AI wiping out jobs, okay? Tech job seekers without AI skills face a new reality, lower salaries and fewer roles. The rise of AI is affecting job seekers in tech who, accustomed to high paychecks and robust demand for their skills, are facing a new reality. Learn AI and don't expect the same pay packages you were getting a few years ago. They want a job for $200,000 and they're not finding it because they don't have the skills, he said. If they were an accounts receivable project manager and they don't know anything other than that, they're going to have a hard time finding a job. AI is projected, according to this report, it's projected that the IT job market in the US is expected to shrink by 20,000 to 30,000 jobs in 2024, this year.
Oh, that'd be
AI,
mean.
yeah.
Sorry, was there a true or false question in there, David?
No, this is just, I want you to react to this.
No, I'm in that camp. And, as a person who has an Austrian economics perspective on the world and the economy, I believe in the concept of creative destruction. Innovation happens. Old ways of doing things are broken. New ways of doing things empower. I think AI is going to be a tremendously creativity and productivity enhancing boon for our species. It's a great thing. But clearly, a lot of jobs are going away. And that's not just going, they're gone. I mean, last year, we had whole swaths of people who would type repetitive real estate listings entries in. That job just doesn't exist anymore. And the same way that, horse buggy or candle lighters and horse buggy whip makers and so on. That started immediately with ChatGPT 3. Now, as the applications apply this new technology to specific solutions for businesses, I think this year, this isn't a someday, somewhen, imminent or inevitable. This is happening now. There are jobs being destroyed right now. So I have no doubt about that. And this is part of my concern now. It's interesting that there are very smart people out there that's saying, well, the AI productivity is actually going to be the thing that holds the recession off. And I have a hard time with that. I'm actually very optimistic, but creative destruction is a real thing, and the destruction happens before the creativity.
I have to just point out, a lot of people were making the comparison to the Industrial Revolution when farmers were, losing their jobs because machinery made a lot of farmers, human farmers obsolete. So they moved to the cities in the UK to work in factories. Yeah, but that was more or less a lateral move. We're talking about manual labor to manual labor. Here we're talking about people who have trained for years, gone to school for a certain profession, and now all of a sudden that profession is obsolete. And so making a lateral move is difficult. They're going to have to either be underemployed for a while and gain new skills, or...
Yeah, no, I'm going to push back on that one, David. I mean, if you were a farmer and you spent your day looking at the hind end of a mule in front of a plow, and now you went to work at a factory tightening bolts like Charlie Chaplin in modern times, that was a very different thing. I mean, you did need to learn new skills. And by the way, some people went to work, making the machines, servicing the machines. There were different jobs, and some of them were higher paid. I think urbanization, as much as it's reviled in movies and stories at the time, it did accompany a rise in the average standard of living. So I'm not sure I would see that as a lateral move, but clearly highly disruptive. And people throw the word disruption around. Oh, we're going to disrupt mining with this or whatever. Like, that's a good thing. Well, the eventual creativity is a good thing, but the disruption causes problems along the way, which are painful. So I I'm not sure where you want to go with this, but my view is that this is actually a red flag for 2024. We're going to see more pain before we get the gain. And it's happening now. That's my view.
Long term, would it be deflationary, the advent of AI?
Yes. Oh, no question. And you know, this is actually a Doug Caseyism, my mentor. The longest financial trend in all of history is deflationary, the lowering cost of living. You know, where you know the poor people today have an infinitely better lifestyle than the kings of yore who didn't have dentists or Novocaine or cancer treatments or whatever, right? Um, you know, over the long term, progress means stuff gets cheaper.
Let's just close off your economic outlook, and then I want to move on to the final segment, which is metals, the core area of your research. So bottom line, you're doubling down on a hard landing. What was your take on the markets? Because I know we've talked about the fact that just because we're getting a recession, it doesn't necessarily mean the markets will move down. Bear market and recession they don't always come together, right? So,
Well, with bear market, they usually have. I said crash.
crash, okay.
It may not necessarily crash.
What's the difference between bear market and crash for the audience?
Well, a bear market can be a long grind lower that doesn't have a waterfall event. You know, a crash is in my mind, it's a 2008 or 1929 or 2020, perhaps, you know, flash crash, you know, that sort of verticality. And, you know, a multi-year bear could take you as low as a sudden crash. But if it happens over years, you have time to see it coming. You have time to adapt your portfolio. It's a much different experience for the investor than waking up on a Black Friday and being worth 25% of what you were on Thursday.
Can we just settle this once and for all? I've heard different theories. The Federal Reserve cutting rates, is that good or bad for stock markets? Historically, it's been mixed. Sometimes immediately following a Fed cut, the stock markets have fallen. Sometimes lowering rates actually is a boost for equities. It really depends on the context. If they're cutting because the economy is bad, usually that means stock markets will fall afterwards.
Right.
But what's your view on Fed cuts?
You've put your finger on the important thing. You know, it should depend on what the cut is, the reason for the cut, why they're doing it. In our current context, investors have been so trained, like I say, it's a Pavlovian reflex. You know, easier money means go risk on. I'm not sure that even if the Fed did cut for bad news, that investors wouldn't look forward to, oh, well, there'll be an easier response, more easy money, and everything will come back. It might take a while for reality to assert itself. Like, you know, holy cow, the Fed is cutting because there are problems, and its cuts aren't fixing the problems. Like for bad news to really become bad news on Wall Street again might take, let me not mince words, I think it probably will take some re-education of investors. And that re-education is going to be a very painful education.
True or false, moving on to metals, there is a lot less production of copper than there will be potential demand or current demand, meaning there's going to be a shortage or deficit of copper production. Therefore, the price will be significantly higher because of that demand-supply imbalance. True or false?
Time frame. This year, next 5 years, 10 years, what are we talking? Because the answer will be different. You know, this year I would say.
Well, how would the answer be different?
This year I'd say false, maybe. Like there have been some problems. We had Cobre Panama go offline last year. We have some shutdowns in Peru. We have things going on. So, you know, borderline for this year, but not for sure. If we're looking 5, 10 years ahead, or even just a couple years ahead, I think there's just nowhere near enough copper. And it's so difficult to permit these big mines, the ones big enough to matter, the mega pit projects and so on that can really help supply the world the increasing electrification, which does not depend just on electric cars, dear audience. You know, the world needs more electricity. Anyway, oh, and the latest big craze is AI, right? AI is going to make our electricity demands go through the roof. Even if that doesn't happen, even if people go completely back to internal combustion engines, there's still going to be more need for Dr. Copper. So the answer depends on the time frame, David. But for this year, unless we get more shutdowns, I don't see a huge deficit this year. And if I'm right about a hard landing, there'll be demand destruction. And so we could actually see the market remain in balance or slightly in surplus this year. We'll have to see.
Not a true false question, but I'm wondering why gold has outperformed silver in both the last 2 years and the last 1 year, 12 months. So I'll just give you, I'm looking at the charts here. As of the beginning of 2022, gold's up 20%, silver's up 6.97%. As of the beginning of 2023, I'm zooming in here, gold's up 16%, silver's up only 4%.
I thought my Darth Silver mask here to answer the question.
I thought I've asked this to a few people this week. I want to get your take. I thought silver outperforms gold during a bull rally, usually, but that wasn't the case the last 2 years.
Well, even Darth will agree with me here. There's several.
What's the story behind that mask, by the way? You can't just bring that on without any context here.
You don't know that the Wall Street silver guys called me Darth Silver?
No, I'm not aware of that.
Oh, wow, you've been out of the loop. So, okay. So the reason for the mask is that I've had the, whoops, sorry, Darth. I've had the temerity to say that there's been a change in the relationship between gold and silver. And these numbers that you're pointing out are case in point, right? The use case has changed. And, the good news is that clearly there's a vastly increased industrial use case for silver. And I do think that is good news because, the investment case, the monetary case doesn't necessarily go away. And so if I'm right about the hard landing and monetary metals get a bid because of the recession, then that would be gold and silver. That'd be good for silver. If I'm wrong and the economy takes off, well, that's good for industrial demand for silver. So that's good for silver, not so much gold. So, people call me Darth Silver and all that, but I'm not anti-silver. I'm not even a silver bear. The reason for the name, though, is that something has clearly changed. These numbers that you're pointing to, you can see it on a daily basis. There's over the last year or two, you look at gold and silver and copper on a daily basis, and the silver line intraday will frequently wiggle more with the copper line than with the gold line. So it seems to be responding to the same stimuli, to the same decisions that copper buyers are making than gold buyers frequently. Now, it is still money, of course. It is the word for money in many languages. And especially since the new war in the Middle East broke out, we've seen silver go back to tracking gold more closely. I find this very reassuring. Yes, it is still a monetary metal. So I like that win-win thesis. But the industrial side could certainly hold it back this year. And you said that silver outperforms gold. Well, even diehard silver bulls will tell you it outperforms gold at the end of the bull market. It typically lags at the beginning and then more than catches up at the end. So if we're going in, we've been consolidating sideways since 2020. We're going on 4 years, David. This is no longer the same bull market of 2019, 2020. If we break out again and we seem to be doing that on the gold side, history tells us that silver will lag at first anyway.
When I first started in this industry, I've observed that silver has had a higher beta to gold, if you want to use gold as sort of the base case. Basically, it just follows gold with a higher beta. It's more volatile. So you'd expect it to move up more in bull markets and move down more in bear markets. It just hasn't been the case in the last 2 years. So I'm wondering why, but that was a good explanation.
Well, sorry, just one more thing. I mean, it's really important if you want to be fanatical about defending your favorite metal or commodity or whatever, fine. Knock yourself out. If there's an ideological agenda here, fine. But don't mistake that for being an investor. If your goal is to make money, what David is saying right now, I mean, this is like truth with a capital T. These are the facts. Just look at it. In 2020, we had this flash crash. Gold and silver fell off a cliff. Gold immediately starts coming back up again, as it should, as a monetary metal should, as a safe haven asset should. And silver just kind of stayed on the mat, right? It's been struggling just to get back to, and it still hasn't hit a new all-time high, nominally even, as gold has. So the market now is, the data is telling us something is different. And you could, I suppose, chalk all of that up to manipulation, but the scale of manipulation to keep silver in the 20s when gold is over 2100 globally, it's just not credible. It's not an easy thing to believe.
Yeah,
So
nobody talks about manipulation when the prices are going up, so that's something to consider. Uh, okay, well, would you use a gold-silver ratio as
no,
as a trading tool? Like it goes above 80, you're short gold or whatever?
no,
No?
no. First, because it's been continually widening, or not continually, it has with volatility been widening for decades now. Like there was a big breakdown in 2020, but that was just the latest in a trend. And the gold silver ratio can close by gold coming down just as easily as silver going up. If anything that gets to an extreme, if the gold silver ratio blows out over 200, say, I would at that point be willing to bet that it would close, or at least somewhat close. But it doesn't tell me which metal is going up and which one's going down.
I heard a very interesting case for agricultural commodities during a war, a kinetic war. Usually grains, wheats, things like that. Things that get imported or exported over distances, those prices go up because of disruptions to the supply chain. And so, ironically, it's become a safe haven to invest in agricultural products during a war. Can you evaluate that? Is that true?
It's hard for me to see something that can rot in a ship's cargo hold as a safe haven, David. And I don't want to use the abused word transitory, but those kerfuffles tend to be ironed out. And there was a big story out there in 2022 when the second invasion of Ukraine occurred about, food scarcity and starving in Africa because Ukraine and everything. And basically, none of the dire scenarios worked out. I mean, it was real. It was a phenomenon. There was food inflation. There's still food inflation. How much of that is due to the war and how much of that is due to money printing, I couldn't tell you. But I can tell you that anybody who bet the farm on this huge agricultural commodities going to the sky narrative, I don't know how many of them lost the farm, but I think they're in jeopardy.
Okay, so final true or false, and we'll leave it there. Given your take on the economy, it's more likely that gold will outperform silver this year by the end of the year?
True.
Okay. Well, that was a fantastic session. We ran through everything. Thank you. Where can we follow your work, Lobo? I know you cover stocks. We haven't talked about mining stocks. We talked about that, by the way. Lobo and I had a very thorough discussion about miners and mining stocks in our January interview from 2 months ago. I'll put a link in the description down below if you want to revisit that episode. So watch that, and also follow Lobo. Where can we follow your work on mining stocks?
Yeah, the easy answer is please sign up for our free weekly newsletter at independentspeculator.com. If you do, I promise I will not spam you with a flood of daily advertisements. I mean, you get one email per week, and then you can see if you like my thinking, via that free product.
Okay, thanks very much. We'll put the link down in the description below. Appreciate your time as always, Lobo. Good to see you. We'll see you again soon.